Startup Stock Exchange presents SSX EDU Interviews. What are the most important factors you look for in a potential company?
But it is important indeed to have a good use of technology and have probably some development capabilities inside an internet initiative, of course. But the competitive advantage due to technological proficiency, I think it's not as important as understanding the market, for instance. I think that understanding the market is much more important. I think we had a very good experience in that with Tucarro.com, the classified media company, in that we were able to become leaders, market leaders by far in Venezuela, without using sophisticated technology. Our competitors use more sophisticated technologies than we do, and they were not able to gain market. So we understood our market much better than they did, and we gave the market what the market really wanted. So we focused, for instance, in selling the car. It might seem silly to emphasize that, but it came out to be a very important strategy in that Tucarro.com emphasized sell your car, vende tu carro en Tucarro.com. And that's what we did. That was our promise, and that was what we actually gave people. We gave people a platform that made it possible for them to sell their cars very quickly. Some people sold their cars even within 24 hours. A large percentage, about more than half the people had sold their cars in about a week, 10 days, 15 days at most. And within the month, about 80% of the people had sold their cars. And what remained were people who were asking too large a price or had cars that were not of interest to the market.
What is the most important lesson you've learned as a startup investor?
I think that the most important lesson is that investors have to have a portfolio strategy. We have made 15 investments. We have joined together with other investors in different parts of the world. And we have learned that even the best entrepreneur teams, even the best market opportunities will not guarantee success, will not guarantee that the investors' goals will be met. So the way to deal with this uncertainty and risk is through a portfolio strategy. So we advise our investors to develop a portfolio. It's not just a matter of getting in love with an entrepreneur and their initiative and making a very enthusiastic investment. We have done that many times, and but time has shown that even our best guesses, our best planning, our best studies, we are very careful in doing our studies of the markets and the entrepreneurs' projections and so forth, and we do the best to our knowledge and capabilities in selecting investment opportunities as best as we can, and that will not guarantee that it will be successful in the sense of meeting the investors' goals. It might meet some goals in the sense that it might not be a total failure, but that is not what the investor wants. The investor wants a large return, and only a portfolio strategy will make it possible to get better returns for investment. I think that another thing that we have learned in the venture capital industry is that investors have other goals besides returns. Because in this industry worldwide, I think there are several worldwide studies about the VC industry, which show that returns are not as good as many people think. I mean, industry-wide, if you look at thousands of VC funds, not that many VC funds actually achieve the return goals on the money invested. So a legitimate question arises that we have asked ourselves and we have answered, and that question is, why are investors still interested in putting the money into ventures? Why are people still interested in supporting startups? And I think that, of course, one driver is looking for high returns. That is a driver, of course, but it's not the only one. I even think that it's not the most important. I think that people who invest in startups do it because the demand exists, the need exists. And the demand in economics, we learned that demand creates a response, an offer. So there are thousands of startups initiatives all over the world, perhaps millions, I don't know. Really, each new generation of people will innovate and develop new initiatives. Technology, like we have been speaking, opens up a lot of business opportunities. So startups happen, and the need for venture capital happens. So somebody, some way, responds. And then we start to kind of analyze carefully the characteristics of investors, and we find that some of the investors are close people to the entrepreneurs. So being close to the entrepreneurs, either family or friend or whatever, having some sort of connection to the entrepreneur or to the business of the entrepreneur will entice people to invest. And the people who do this, sometimes they do it because of the relationship, the value they give to the relationship, and the value they give to the opportunity that the entrepreneurs are taking in a very humanistic way, I would say, in a very humane way, including affection. But there's also another factor, and I think that people who invest in startups are passionate about business. I mean, they like to be close to where business are starting, to the creation of new companies. So these people who are passionate about business, they like business, they like to talk about business, they like to learn about new businesses. These kind of people also become investors. Then there are other sort of more institutional drivers, like large companies who want to innovate, and then they develop a strategy for investing in entrepreneurs. Like for instance, Telefónica, which is one of the largest telco companies in the world, for Spanish origin. They have strong VC investment strategy. And in Venezuela, we have, for instance, a media company called Cadena Capriles, which has had a very, very important investing strategy on entrepreneurship and startups, both from third parties and both from inside their organization. So